I was a financial planner in the U.S. for about 25 years, and we used to have to take these continuing ed classes each year to keep your license up to date. If you didn't keep it up to date, you lost your license. Some of the stuff that we used to learn were a lot of tax strategies and kept us up to date with new laws that were coming out, dealing with investment insurance products, things like this. One of the things that used to get me frustrated years later was the toolbox they gave us was always half empty. Never really gave us foothold in really showing people how to get their income taxes to zero. Tax strategies that we used were like getting people to use 401ks, KIOs, IRAs, different types of money purchase. You have 401k plans. But the problem with these statutory type programs will never get your income taxes to zero. In fact, it can actually throw you in a higher tax bracket when you hit retirement age. Let me explain to you how that works. If you're real good at saving your money and you're putting a lot of money away every year through retirement accounts, what happens is the IRS has tables for you how long you're supposed to live, just like they do with annuities. They also have it with IRAs and type retirement programs on when you're supposed to, a maximum age that you have to start pulling your money out. And they take an average, out over that time period from the time you retire to the time that you die. In other words, there's actually mortality tables for that. So the longer you wait to pull the money out, in other words, if you start pulling your money out at 70 and a half instead of at 65, more than likely you're going to end up pulling out a lot more money than if you pull out at 65 years old. The problem is that most people might not need to pull the money out because they're still working or they don't need the money. But the problem is if they have to start doing it at 70 and a half retirement programs. So what happens is it ends up throwing you in a huge tax bracket in a lot of cases if you're a big saver. Because what happens is if you're supposed to die at 80 or 82 years old, okay, then you've got approximately just a few years to pull the money out. Obviously, if you start pulling the money out at a later age, then the mortality tables go up as far as when you're supposed to die, as far as that age goes. But the thing is you could be pulling out a lot more when you retire than what you were making when you were earning income, which just throws you in a higher tax bracket. So although you're tax deferring a little bit as you go along, you're not getting your taxes to zero, number one, so you're still paying high taxes. And then when you hit retirement age, you think, well, now I'll be pulling my money out. Well, sure, you can pull your money out, but now you could be paying more taxes than when you were earning money, okay? Because now you've got to pull out this money in a squeezed up period of time. Most people are not familiar with these mortality charts and how IRAs and KIOs and money purchase and 401ks work. You're pulling the money out. See, the IRS has these tables because they don't pull this money out after you're dead, okay? They want the taxes to be paid out during your lifetime. Now, they don't know when you're going to die, but they do have mortality charts that show approximately when you're supposed to die, okay? And they group together smokers and non-smokers. It doesn't make any difference. But these tables depend on when you pull the money out. That's the time period that all that money should be pulled out. The problem is you might not need it because you got, money other places, from Social Security, other places, you just don't need to do it. They make you pull it out, okay? And then you're taxed heavily on it, okay? And that money also could be part of your estate taxes, depending on what size of state you got. The problem with this is they don't show you, they never taught us in these continuing ed classes, and also, I got my 663 and 26 and other stuff. And by the way, too, we don't do that now. We're in the citizenship by investment business. You can talk to your accountant or your tax advisor on this, or your financial advisor. We don't deal with that type of work anymore. We deal strictly with citizenship by investment, and we also deal with investments in properties. But this is the key right here is you need to understand the toolbox is not filled up, okay? It's always half empty when you deal with financial advisors because they're not going to tell you everything that you can do out there. A lot of the stuff you're going to have to learn on YouTube from videos like this because you're just not going to get it from the financial advisor. If you go to a tax lawyer, a tax accountant, you say, look, I want to get my income taxes to zero. He's going to look at you kind of funny, and he's going to say, well, there are basically two ways you can do that. You can take a loss or you can break even, okay? That's one way you can do it, but why would you want to do that? And he's true. Why would you want to do that, okay? The key is to try to find a way to get your taxes to zero, okay, and not be taking a huge loss on your business, all right? but you're not going to be doing this in high tax countries. All right, you're going to have to do two things that you're not going to get from your financial advisor. One is you're going to have to move your business overseas. Okay, you're going to have to qualify for the foreign overseas exclusion. That's one thing that was not in our toolbox when we were learning all this continuing ed. Okay, they didn't teach you about the foreign overseas exclusion. They didn't teach you about relinquishing your U.S. citizenship. If you're from Canada or Austria or one of these high tax countries that the taxes you based on residency, most of these accountants are not going to tell you, hey, you can pick up your bags and move overseas to a tax haven and have a business there and not have to pay any income taxes at all. You don't have to take losses or nothing. If you make $10 million, you can keep 100% of the $10 million. They're just not going to tell you this, okay? I promise you. If you bring it up, okay, they might go back to the toolbox. In other words, start investigating this stuff, do just like you did on YouTube and start looking at it and Googling it and stuff like this, and then find out there are ways that people can put money in tax deduct $112,000 a year, husband and wife, for the foreign overseas exclusion for this year, or have unlimited amounts relinquishing your U.S. citizenship. But he's not going to tell you. You bring it up to him, then he goes out and checks on it, comes back to you and pays you a bill. And then basically what you've done is you've educated him and he's charged you money to do exactly what I'm telling you right now. My whole thing is this right here. You're going to have to think out of the box. Don't depend on your accountant. It's just like I had 3 accountants I bet during my lifetime I took my tax returns to that weren't even doing my taxes. I was going from different accountants just to see, hey, can you show me something that's different? And you know, the thing is, as a financial advisor, we learn pretty much about everything out there. But there are some things that they don't teach us. Me jumping to a tax advisor like an accountant or a tax lawyer or somebody like does the taxes, most of the stuff they came back with me, you know, already knew. We took all this stuff in the Series 663, 26, all the insurance tests we took, all of this continuing ed classes. We already took all that stuff on the IRAs, the 401ks. So these guys coming back to me, they're telling me that I can't do any more. I already knew that pretty much, but I thought maybe there's a slim chance, maybe they've come across something that's different. They never did, okay? And what you're going to find out is this stuff, you're going to have to learn yourself. You're going to have to basically get your business up, move overseas. I'm not saying you got to start over with your company. I'm just saying take it and move it where the tax advantages are a lot better. This is how you're going to do it. Most accountants have never done a foreign overseas exclusion tax form. Most accountants have not done forms dealing with relinquishing U.S. citizenship. One reason is very few people relinquish to begin with. The ones that do, you got a small few accountants have actually even handled this, and most of them are tax lawyers. So you get that advice is pretty difficult to find. So, you know, that's why we deal with people that specialize in this. They do a lot of this, okay? We don't do tax forms. We do the tax advising and stuff like this. We have other people with our company that actually deals with that. And these are the ones that we actually refer you to. But anyway, folks, using real estate, things like this to try to lower your taxes, I'm telling you, all it is a tax bomb. I was just talking to an accountant the other day that sold a bunch of properties. He's got a huge tax bomb right now that he's thinking about borrowing the money to pay for it. These were properties that had a lot of depreciation that was added as capital gains over the years. And then what happens is when you sell those properties, you got a big tax bomb. You can defer it, but one day there's going to be a huge tax bump down the road. Principles that we use are not deferrals. These are this is how to make your money tax-free. You're not looking for a tax bomb down the road. And this is what we try to teach people how to do. If you want to know more on this, go to our website, www.citizenshipquickly.com. Just ask for some help. If you've got a question or comment, put it below. And again, don't forget to hit the subscribe button on the right of your screen right here. Videos automatically as they come out. And I look forward to talking to you on the next video. Take care.